On the 1st of January 1933, a retiree withdrew her first $40,000 in living expenses. She had $1 million to her name, held in a 60-40 portfolio of stocks and bonds. She planned to withdraw 4% of her balance each year, adjusted for inflation, for 30 years. The country was 3 years into the Great Depression. The stock market sat at roughly 1/5 of its 1929 peak. Breadlines stretched across cities. She was retiring at the bottom. On the 1st of January 1966, another retiree began the same way. Same balance, same portfolio, same withdrawal plan. The economy was healthy. Inflation was 3%. No catastrophe loomed. On the 1st of January 2000, a third did the same. The dot-com bubble was near its peak. Stocks had averaged more than 20% a year for the previous 5 years. 3 identical retirements. The only thing that differed was the year on the calendar. 30 years later, the first retiree, who had retired at the very moment the market had given up, died with roughly $2.5 million in real terms. Comfortable by any measure. The third retiree, who endured the dot-com crash and the global financial crisis in her first 9 years, ended with around $500,000, bruised but alive. The second retiree, who had faced no famous crash and no headline-grabbing catastrophe, just 16 years of inflation, ended her 30th year with almost nothing. Retiring into the ruins of the Great Depression turned out to be the best decade a retiree could ask for. Retiring into a calm 1966 was the worst. Same plan, same fund, same withdrawal rate. Different decade, different lives. The reason hides inside something most retirement plans never properly account for: the order of the returns. A return is a multiplier. A loss of 10% leaves a portfolio worth 90% of what it was. A gain of 20% leaves it at 120%. To find what a portfolio is worth after several years, the multipliers compound. Multiplication has a quiet, useful property. Order doesn't matter. Lose 20%, gain 20%, gain 20%, and the portfolio ends at 115.2% of where it began. Reverse the order entirely, gain 20, lose 20, and it ends at exactly the same place. The same returns, applied in any order, give the same result. This is why a long-term investor, decades from spending the money, can ride out almost any storm. The math is on her side. But a retiree is not a long-term investor in this sense. A retiree withdraws. Apply the same returns again in the same 2 orders, but this time take $100,000 out at the end of each year. The portfolio that started with a loss now ends almost $90,000 behind the portfolio that started with a gain. Same returns, same withdrawals, same average. Different order, different ending balance. Withdrawals break the symmetry. They turn a path-independent calculation into a path-dependent one. And in retirement, that asymmetry is the difference between a comfortable 30 years and an emergency in year 18. Every withdrawal in retirement is a sale. When a retiree pulls $40,000 from her portfolio, she sells shares of whatever she owned to raise the cash. If those shares were worth $100 apiece, she sold 400 of them. If they were worth $50 apiece, because the market had fallen, she sold 800. The shares she sells are gone. They cannot compound for her anymore. Whatever they would have grown into over the next 29 years, that growth no longer belongs to her. This is the hidden cost of every withdrawal, not just the cash she received, but the future value of the shares she released to get it. A withdrawal in year 1 carries a 29-year shadow. A withdrawal in year 15 carries 15 years. A withdrawal in year 28 carries almost nothing. When the early years of retirement coincide with bad markets, 2 things happen at once. The shares are cheap, so the retiree must sell more of them to raise the same $40,000. And the shares she sells have the longest compounding window ahead. She pays double selling more and selling earlier than she would have wanted to. This is what kills retirements. Not the crash itself, the withdrawals during the crash. The same set of returns can be ordered two different ways for the same retiree. The retiree whose first 3 years are -20, -15, and -8%, followed by 27 years of recovery and growth, sells most of her shares at the lows. The shadow cost of those early sales, compounded over the long bull market that follows, is enormous. By year 30, those early withdrawals have cost her not just the cash, but several $1 million of growth she never saw. The retiree whose order is reversed, 27 years of growth first, then -20, -15, -8 at the very end, sells from a much larger portfolio in the early years. She sells fewer shares. And the early shares she does sell would have only had a few years left to compound anyway. Her shadow cost is a fraction of the first retiree's. Same returns, same withdrawals, same total dollars taken out. Wildly different shadow cost, wildly different outcomes. The math says, the earlier a return happens in retirement, the more it matters. A 1% change in the year 1 return moves the final balance by tens of thousands of dollars. The same 1% change in the year 29 return moves it by a few hundred. The first 10 years of retirement are not just emotionally fraught, they are mathematically decisive. Look at what each of the 3 retirees got assigned inside that window. The first retiree retired in January 1933. The market had already given up. The worst of the crash was behind her. What came next was a 13-year recovery. Her first 4 years included +50%, +47%, +32%. Extraordinary returns, all of them compounding on a still full portfolio. The vulnerability window worked for her. The second retiree faced no single catastrophic year. She faced 16 consecutive ones. Inflation chewed through her real returns from 1966 to 1981, the exact stretch that mattered most. Her vulnerability window aligned, with cruel precision, against the worst extended bear in the history of the post-war United States. The third retiree faced 2 crashes, the dot-com bust and the global financial crisis, both inside her first 9 years. The post-2009 recovery was steep enough to partially repair the damage. She survived. Barely. The vulnerability window cuts both ways. The decade that defines a retirement isn't chosen, it's assigned. The first retiree was assigned the right one, the second, the wrong one. The third, a hard one she barely survived. A retirement plan is not a guarantee, it is a probability distribution. To see the shape of that distribution, simulate 10,000 retirees, each starting with $1 million, withdrawing $40,000 a year, holding a 60-40 portfolio. Each retiree receives a different random ordering of historical US returns over 30 years. The 10,000 outcomes do not cluster around a single number. They spread across a wide range. About 1 in 10 retirees runs out of money entirely. About half end with somewhere between $500,000 and $2 million. A small fraction end with 5 times what they started with, because they happen to retire into a bull market that compounded for 30 years. The same plan, run 10,000 times, produces 10,000 different outcomes. The retiree's skill is identical, her plan is identical. Only her luck, the order of the years she lived through, is different. The historical retirees fall at specific points in this distribution. The 1966 retiree lands in the failure tail. The 1933 retiree, who retired at the bottom of the Great Depression, sits well above the median. The 2000 retiree lands in the lower half. A retiree who began in 1982, drawing from her savings at the start of the longest bull market in modern history, sits in the top decile. None of the 4 earned their place. Each was assigned it by the year she happened to turn 65. The 4% rule comes from a single piece of research published in 1994. The financial planner, William Bengen, asked a precise question. Across every rolling 30-year period in US history, what is the highest withdrawal rate that survived even the worst of them? The worst rolling 30-year period turned out to be 1966 to 1995, the same stagflation that nearly destroyed the second retiree. The withdrawal rate that would have just barely survived even that period was 4.15%. Bengen rounded down. The 4% rule was born. But Bengen's data ran from 1926 to roughly 1992. The market valuations in his sample were, on average, lower than they are today. When his earliest retirees began, stocks were cheap by historical standards. When today's retirees begin, stocks are expensive. Rerun Bengen's exercise across a range of starting valuations, and the shape that emerges is not a flat 4%, it is a sloped surface. When stocks are cheap, 6% is sustainable. When they are expensive, 3.5% is closer to the truth. The 4% rule is not wrong. It is conditional. It is the answer to a question that has a different answer in different markets. There is no way for a retiree to control which decade she retires into. But there are 3 modifications to the plan that the math says shrink the failure tail. The first is dynamic spending, a rule that says if last year's portfolio fell by more than 15%, this year's withdrawal is cut by 10%. When the same 10,000 retirees follow this rule, the failure rate drops from 12% to 4%. The retiree gives up some upside in exchange for survival. The second is a bond glide path that runs in the opposite direction from conventional advice. Instead of starting retirement aggressive and getting more conservative, start retirement conservative and become more aggressive. The early years, the vulnerability window, are protected from equity crashes. By year 10, when the math no longer cares as much, the portfolio shifts back into stocks for long-term growth. The third is a cash buffer. 2 or 3 years of expenses held in cash, replenished only after a positive year. The retiree never sells equities at the bottom because she is not forced to. She spends from cash instead. Each of these gives up something to gain something. None of them is free, but each collapses the failure tail of the distribution by a meaningful amount. The 1933 retiree did not have a better plan than the 1966 retiree. She had a better decade. The 1966 retiree did not make a single bad decision. Her returns averaged 7% a year over 30 years, the same long-term average that made every other retiree comfortable. She failed because her 7% average had its worst years stacked at the front, and because nothing in her plan accounted for that possibility. The 4% rule does not protect against this. It survived 1966 by a hair. The next worst sequence might not be survivable at 4% at all. What the math says simply is this. The returns retirees average matter much less than the returns they receive first. The order is everything, and no investor, however careful, can choose her order. The plans that survive are the plans that account for this, by spending less when markets demand it, by holding bonds when stocks falter, by keeping a buffer of cash for the years that nothing else will fix. The question in retirement is not what was averaged, it is what came first.